Hey everyone, welcome back to the show. Thanks for tuning in. My name is Mike, this is my whiteboard, and today we're going to be talking about a bearish strategy. We're actually going to go through a checklist of the covered put, which is really just the opposite of a covered call. So instead of buying 100 shares of stock and selling a call against it to reduce our cost basis, we're going to be looking at shorting 100 shares of stock and selling a put against it to reduce our cost basis. So it's just the opposite. There's a few differences that I want to point out, but with the market consistently rallying and a lot of speculation on where the market might go, I wanted to present this as an opportunity to learn about the covered put and go through the checklist of what I look for and what we look for at deploying a strategy such as this. So let's get right into it, and we will begin by talking about just what that covered put is. So like I said, instead of buying 100 shares of stock and selling a call against it like we would with a covered call, the covered put is the exact opposite. So you might notice that instead of routing this for a debit, which is exactly what we would do for a covered call, we're actually going to be routing this for a credit. Since we're selling 100 shares of stock, even if we don't own the shares, we're going to be selling 100 shares, which is going to result in a credit, and we're going to be selling an out-of-the-money put below that share price, which is going to increase the credit we receive and ultimately reduce our cost basis or improve our cost basis on this short share position. So when we're looking at a covered put, this is going to be our go-to strategy when we're looking at just becoming short stock. So instead of just shorting stock and leaving it at that, we don't tend to do that because it leaves us with that 50-50 shot. Just like we don't really believe in buying shares outright, we're always going to look to reduce our cost basis, and especially with covered puts, it's going to be a lot easier to do that and collect a much higher credit with selling an out-of-the-money put than we might see with selling an out-of-the-money call when we're looking at a covered call. A lot of times we might not be able to collect a very nice premium for selling that call, so we might wait until we see a rally and then sell a call that's closer to the money. But when we're dealing with a covered put, it's much easier to obtain a nice credit for selling an out-of-the-money put because of the fact that usually in a regular volatility skew market, we're going to be looking at puts trading richer than their equidistant calls. So when we're looking at a covered put strategy, we like this because, number one, it allows us to profit if the stock price doesn't move, just like a covered call would, and ultimately it allows us to improve our cost basis. So even if the shares do go up in price, we're going to be at a less loss than if we were to have just shorted those shares outright. So when we're looking at the assumption of this strategy, it is neutral to bearish for that reason. And when I say neutral to bearish, of course, the best case scenario is when the stock price actually goes down, because that would result in allowing ourselves to buy back this position for a lower price, which is exactly what we'd want to do. But in any case, we're going to want a high IV environment to, number one, help us get a much larger credit for that short put than we would in a lower implied volatility environment. If we're just thinking about what implied volatility does, it's really just a metric that we look at where we're analyzing the Black-Scholes model, we're analyzing all the inputs into the Black-Scholes model, and we're trying to solve for some sort of implied volatility based on those inputs. So the higher the option prices are, the higher the implied volatility is going to be, and the lower the option prices are relative to themselves, the lower the implied volatility is going to be. So when we see a high IV environment, that is indicative of higher option prices, which is exactly what we want when we're selling those options. So let's go on to the next slide, and we're going to talk about what happens when the stock price goes up, stays the same, or goes down with this strategy. So the worst case scenario for this strategy is if the stock price goes up. Number one, our short shares are going to gain value, which is not what we want. We have to remember that we did not buy these shares, we actually sold them. So if I sold shares here, the only way I'm going to profit is if I can buy them back at a lower price. So if I sell the shares here and they continue to gain in value, for me to close this position, I then have to buy them back at this higher level, which is going to result in a negative P&L. So the worst case scenario is that the stock price does go up, our short shares will gain value, but when the stock price goes up, as we know from just a short put position, so if I imagine that I didn't sell these shares and I just had that short put, when the stock price goes up, that short put's going to continue to be further and further out of the money, which is going to reduce the value of that short put. So although we're going to see losses on those short shares that we have, the short put that we sold is going to help hedge that loss. So in any scenario, regardless of whether we're selling 100 shares outright, and we compare that to selling 100 shares outright and also selling a put, this strategy is going to lose less in any scenario than if we had just sold those shares outright, because of the fact that we're selling that put to reduce and improve our cost basis. If the stock price stays the same, we're going to have theta decay working for us. So just a quick reminder, theta decay, or theta, is just a measure of an option price decaying over time, over 1 day specifically, all else equal. So when I say all else equal, if we imagine that if we froze that stock price and we froze implied volatility movement, whatever theta value you see, if you froze all other moving aspects of the trading market, if we looked at that same option the next day, it should have decayed by that same value. So when we're looking at selling premium, theta decay is on our side. It's going to be a positive value because, again, when I'm selling an option, the closer we get to expiration, the less and less it's going to be worth. So if I sell an option here, every single day that passes, theoretically, it should decrease in value if we freeze the stock price and freeze implied volatility, which would both affect the value of the option and that extrinsic value of the option when we're talking about implied volatility. So if the stock price stays the same, just to keep it basic, we're going to have theta decay working for us, and the short put's going to lose value, which means that I can easily just buy back these shares right at that same value, but at expiration of this put, I'm going to be able to buy back those shares at the same price, but since I collected premium on that short put, I'm going to be at a winning position. I'm going to have a profit on that trade because even though I didn't profit anything from those short shares, I will have profited by selling that put and watching it expire worthless, because we're going to be collecting a credit when we sell an option, and if that option expires worthless, I can then think of that credit I received as profit. So the best case scenario for this strategy is when the stock price goes down. The very first thing is that, of course, the short put is going to gain value, which is going to be bad, but our short shares are going to lose value, which is really what we want in this scenario. So when the stock price moves down, the short shares are going to lose value, which allows us to buy back those short shares at a lower price. But there's one thing I want to point out with the short put gaining value. The short put's going to gain value, but as long as it stays out of the money at expiration, it will expire worthless. If it goes in the money, which just means that the stock price would move below that short put, you're going to see losses on that short put, but what you're going to see is that it's going to be intrinsic value, especially when we get closer and closer to expiration, and most exemplified is going to be on that expiration day. We're going to see most of the value of that put, if it's in the money, be intrinsic value. And one thing we know about intrinsic value is that shares of stock have it. So if I have 100 shares of stock and I'm short those 100 shares of stock, and I have a short put that's going to see losses of intrinsic value if it's in the money, I'm not going to be worried about it because I know that my short shares are completely offsetting that. So really, if the stock price moves down and it blows through our short put and it drops even further, that's going to be the best case scenario because, number one, any intrinsic value losses I see with my short put are going to be completely offset by my short shares of stock, and the extrinsic value is going to be completely dissipated from that option, which is exactly what I want at the end of the day. Since I sold this option out of the money, it's going to be all extrinsic value. So all the value that I sold this option for is going to be time and volatility value. So as long as that is gone from the option by expiration, or if there's a lot of it gone before expiration if I close the trade, that's exactly what I want. And in the best case scenario here, the stock price would drop significantly, and hopefully we can close that trade very quickly for a nice profit. So let's go on to the next slide and we'll talk about a few things that we consider when we're looking at this strategy. So the very first thing I want to point out is the break-even calculation. So when we're looking at selling premium, we're usually thinking about taking the stock price or taking that strike price and subtracting the premium from that strike. Well, here it's going to be a little bit different because we're shorting shares of stock. So this calculation is going to be looking at the share price, and we're going to add the credit to that share price. So let's say I shorted 100 shares of stock at 50. So let's say the stock was trading at $50, and let's say I collected $1 in premium for selling that put. My break even is going to actually be 51. So if I take that share price of 50 and I add the credit of $1, that's where I get that 51 mark. And the reason why we're adding the credit here to the short shares is because we have to think about our cost basis and where our break even is going to be. So if we remember, if I'm selling shares here and the only way I can profit is for the shares to go down, that means that when I'm looking at losses, the shares are going to be going up. So when the share price goes up and I have to buy it back at this level up here, that's when I'm going to see losses. But if I'm selling premium, in this case $1 of premium or $100, I'm going to be able to offset that loss by $100, which is why we have this example where if I'm selling shares at 50 and I sold premium of $1 to offset those losses, my shares can now go to 51 and I'll still break even because of that $1 I collected from the put. So it's a little tricky when we're looking at a covered put because we're actually adding the premium to our shares as opposed to subtracting it. We always usually think of cost basis as something we're bringing down to zero, but since we're shorting shares, it's just the opposite. With implied volatility, as we stated before, the higher the IV, the better. And that's just because, number one, it implies movement in the stock market, which, number one, is going to give us a better chance or a better theoretical chance of the stock price moving around. Hopefully it moves to the downside, which is exactly what we want. But because of that implied movement, these options are going to be worth a lot more. So if I'm selling or shorting shares at 50, and maybe I'm looking at selling this put at the 45 strike, in a low IV environment, I might only be able to collect 50 cents for that put. But in a high IV environment, in that same exact expiration and same exact strike, I might be able to collect $1. So it's really important to look for those opportunities where we have those high implied volatility environments where we can collect a lot more for the same exact strike, which is exactly what we'd want to do to, number one, help improve our break even, and number two, help improve our daily P&L for every single day that these shares don't move. And that's what we're talking about when we're looking at theta. So when we're looking at closing this strategy, it's going to be very similar as when we're comparing it to a covered call. So really we have to ask ourselves, am I okay with holding onto these shares? Or do I want to make sure that I'm really just looking for a quick profit and I really don't care if I hold onto the shares? So if I want to hold onto the shares, maybe I'll look at closing this put at 50% profit or something along those lines. But if I'm not too worried about the shares, then maybe I would look at holding it until expiration and just letting the theta work for us and letting the probabilities play out. Because if I want to hold on to the shares, I'm going to have to eventually close this put, because if I have this put go in the money, so let's say the stock price drops well below the put strike, at expiration, this put is going to be automatically exercised into 100 long shares of stock, because a put contract is the right to sell 100 shares. So if I'm selling the right for someone else to sell their shares to me, I'm now going to have 100 long shares here and 100 short shares here. And the brokerage isn't going to allow us to have 100 long shares and 100 short shares, so it'll be completely wiped out and you'll see no position there anymore. So if we want to hold on to these shares, we'll have to eventually close out that put before expiration. But let's go on to some takeaways and we'll wrap it all together for you. So the very first takeaway is that this strategy is neutral to bearish, and it's a cost basis reduction strategy. So instead of just shorting shares outright, we're looking to reduce our basis or improve our basis by selling that out of the money put against the shares. High IV environment is best for the reasons we just talked about. And again, when we're closing the trade, just ask ourselves, do we want these shares, or are we okay with having these shares be taken away from us at expiration? And if we're looking at defense, I'm actually going to cover defensive tactics tomorrow. So I'm really going to dig into what we can do when the stock price moves up, stays the same, or goes down, and some examples of exactly what we would do in those scenarios. So be sure to tune in tomorrow, 5/18. So thanks so much for tuning in. If you've got any questions or feedback, shoot me an email here, or you can follow me at DoTraderMike. Stay tuned though, we've got Jim Schultz coming up next.